Well, setting aside money to save and invest has become less of a priority for some Canadians as they deal with a rise in basic living expenses. According to a survey by the Bank of Montreal, fewer Canadians contributed to a tax-free savings account last year. It found the proportion of Canadians who said that they have a TFSA fell from 66% in 2022 to 62% last year. For more on the health of the Canadian consumer, let's bring in Sal Guattieri. He's director and senior economist at BMO Capital Markets. Sal, thanks so much for joining us this afternoon.
Welcome.
So interesting data coming from this Bank of Montreal survey about Canadians investing less or fewer Canadians investing in a TFSA last year. What do you think are some of the driving forces behind it? I talked about the rise in basic living expenses, making people having to prioritize maybe spending on those rather than saving and investing.
Yeah, I think that's really what it comes down to is just the rising cost of living that's hurting so many Canadians. At the same time, many Canadians who did rack up a lot of debt over the last several years or so are working to pay down that debt in this higher interest rate environment. So I think it's a combination of both, but it's clearly the rising cost of living. Inflation has come down, but the important thing to note is that prices are still going up at well above a normal rate, in excess of 3% in the past year to December. And some things such as food and rents are going up even faster than that. So that's really hurting a lot of Canadian households, just leaving them with less money in their pockets to invest in savings accounts, in this case, in the tax-free savings account, or simply to spend at all. We received a pretty disappointing retail sales report this morning for November, basically confirmed that Canadian consumer spending is almost flat on its back. It has been for the past several quarters now, probably extended right into the final quarter of last year, may have extended right into the first quarter of this year, we believe. So that's pretty remarkable when you consider that the population has probably increased about 3% in the past year. That real consumer spending has stalled. So basically, it means people are cutting back. The typical person is cutting back their overall spending. And clearly, they have less money to park in a savings account, in this case, in a tax-free savings account.
When it comes to that retail sales data out today, though, Sal, at least the early estimate from StatsCan for December looked like it would, more than reverse the decline that we saw in November. So, is it just people maybe stretching themselves for the holidays? Maybe it's credit cards are coming out in order to do that, do you think?
That could be the case. We'll see when we get the final retail sales number, because that advanced estimate can be off the mark quite a bit. We also know that prices did go up for goods in December. So some of that increase in the flash estimate of retail sales could simply reflect higher prices, not higher volumes. But again, it's an initial estimate based on I think half of the surveys that normally come in for the month. So when we get that final figure for December, my sense is it probably will be revised down, revised lower. But at least the data we have on hand up till November, the more accurate numbers, do suggest that retail sales volumes, so stripping out higher prices, have slowed in the last 6 months to about a 1% annualized rate over that period. And again, if you factor in also services, which largely are not included in the retail sales report, real consumer spending was flat in the second quarter, flat in the third quarter, and we believe pretty well stalled in the final quarter of last year as well. So basically, you have a consumer that's pretty well flat on their back right now.
And how does the Canadian consumer compare to the U.S. consumer? Because we got U.S. retail sales data out this week as well, Sal.
Yeah, night and day. American consumers are showing their resilience, largely because they have, on average, much less debt to work down than Canadian households. And as well, their mortgages are long-term. So they're pretty well insulated from this spike in mortgage rates of over the past couple of years. So they really are shelling out historically quite a low amount of their income on debt payments compared to Canadian households who on average are shelling out a record amount of income to service their debts. And that's only going to go up as more Canadian households refinance their mortgage over the next 2 to 3 years. A recent Bank Canada estimate suggests that that typical mortgage holder will probably see a payment increase on the order of about 1/3. And that's assuming interest rates fall over the next couple of years or so. So it's a completely different situation. Consumer spending in the U.S., and as we saw the retail sales report for December earlier this week, is holding up remarkably well. And that's really what's powering the U.S. economy forward. The growth differential between the two countries, GDP growth differential, is in excess of 1 percentage point now, which historically is quite significant. And that's why we think the U.S. economy could grow about 1.7% this year, almost fitting in the no landing camp, something we thought would be pretty impossible when inflation had soared to 9% at one time, compared to Canadian growth this year, GDP growth, which we peg at about 0.5%. So big difference in performance, and it's all largely on the back of the diverging consumer performance.
Sal, we've only got about 30 seconds left here, but the Bank of Canada does make its next rate decision in less than a week. We'll also get the monetary policy report. We'll get a press conference. We're going to get a press conference every time now from the Bank of Canada, so we'll really be hearing lots from them. What are you expecting to hear?
Well, for the Bank Canada, I mean, rate cuts, they probably know rate cuts cannot come soon enough for Canadian households and the economy, because the economy is on the cusp of a recession. We contracted in the third quarter. The fourth quarter is going to be touch and go as to whether we'll see another contraction. We don't think so, but it's going to be close. So the Bank of Canada would probably like to cut interest rates about now, because they know Canadian households are struggling under these higher interest rates and higher debt payments. The problem is they can't, because inflation is still running north of 3%. The core measures of inflation, at least the ones that Bank Canada tracks, are in the 3.5% range. So well above the 2% target. They simply cannot cut rates this soon. So I think what they'll suggest is that probably more clearly than last time, instead of warning that the next move is going to be an interest rate increase, they might kind of downplay that a bit, suggest perhaps the next move is going to be a rate cut, but not anytime soon. We don't think the bank will cut rates until June of this year.